So here's the big question on a lot of investors' minds right now. With interest rates looking like they're headed down, is a classic safe stock like Procter Gamble a total no-brainer? Or is this consumer giant just way too expensive for what it is? We're going to dig in.
And this really gets to the heart of the matter. The whole market is buzzing about potential rate cuts. For a while there, high interest rates meant cash was king, but now, everybody's looking for the next best place to put their money. And that's putting a huge spotlight on companies just like P&G. And let's be clear, we are talking about an absolute titan, a market cap of over $326 billion. P&G isn't just a company, it's a global economic institution. Its products are in pretty much every home, and that scale is exactly why its stock is such an important bellwether.
All right, here's how we're going to break this all down. First, we'll look at the challenges P&G is up against. Then, we'll dive into the bull case, the argument for buying. After that, we'll hit the bear case, the argument for staying on the sidelines. We'll peek inside the business itself to see how it's really performing, and then wrap it all up with an investor playbook to help you figure out what to do.
Okay, so before we even get to the whole interest rate debate, we've got to get a clear picture of what P&G looks like right now. Because this isn't a simple story. We're talking about a top-tier company that's navigating some seriously choppy waters.
And this right here, this is the real dilemma, isn't it? On one hand, you have this incredible legacy, 69 straight years of raising its dividend. That's the textbook definition of a safe, defensive compounder. But then you look at the other side of the coin. It's expensive, and maybe more importantly, people aren't actually buying more of their stuff. Volume growth is stuck at zero.
Okay, now for the fun part. Let's talk about the case for buying P&G. This is the classic argument, and it's one you really need to understand, especially in this kind of economic environment.
So, the key term you need to know here is bond proxy. What on earth is that? Well, think of it like this. When interest rates drop, the income you earn from a super safe government bond gets smaller and smaller. So investors who need that steady income start looking around for an alternative. And a stable, reliable dividend-paying stock like P&G starts to look like a great substitute, a proxy for that bond.
And you can see exactly how this plays out right here. Right now, a 10-year Treasury gives you a better yield than P&G's dividend. But as rates get cut, that Treasury yield bar is going to shrink. And as that gap closes, P&G's steady dividend suddenly looks a whole lot more attractive. That could pull in tons of new investors and push the stock price up. But hold on, it's not nearly that simple. Let's flip the script and look at the case for waiting, because there are some really powerful arguments against jumping in right now. This chart pretty much lays out the whole argument in black and white. Just look at that forward PE ratio. At over 25 times earnings, you're paying a huge premium for P&G compared to its direct rivals. It basically means the market has already baked in a lot of good news, which might not leave much room for growth. You could say it's already priced for perfection. And here's the twist. The reason the Fed is cutting rates is a huge deal. If they're cutting rates because the economy is actually strong and inflation is under control, investors might not run to safety. They might do the exact opposite. They could see it as a green light to get risk on and pile into higher growth areas like tech, leaving defensive stocks like P&G in the dust.
Okay, enough with the macro theories. Let's pull back the curtain and look at how P&G, the actual business, is doing. What do the numbers from their latest report really tell us?
At first glance, you see 2% organic growth and think, hey, not bad. But, and this is a big but, look closer. That growth didn't come from selling more detergent or diapers. Nope, it came entirely from jacking up prices. The actual volume of stuff they sold, it was completely flat, zero.
And if you break it down by division, you can see exactly where the engine is sputtering. The beauty business is doing great, pulling all the weight. But look at their two biggest segments, fabric and home care and baby and family care. Together, they're more than half the company, and they had zero growth. The core of the business has stalled out.
And as if all that wasn't enough, there's a huge shakeup happening at the very top. The company's getting a new CEO, an operations guy, which tells you their focus is shifting hard towards one thing, efficiency.
And that new focus on efficiency, well, it's already making waves. They've announced plans to cut 7,000 jobs, non-manufacturing jobs. That is a massive number, and it shows you just how serious they are about protecting their profit margins right now.
So why make such a drastic move? Well, management is calling it a self-insurance policy. Basically, they're looking ahead, they see potential trouble from things like tariffs and rising costs for materials, and they're trimming the fat now to protect themselves later. It's a classic defensive move from a defensive company.
All right, we've thrown a lot at you. The bull case, the bear case, the nitty-gritty details of the business. So what in the world do you do with all this information? How do you make a smart call?
Look, there's no single right answer here. It really comes down to who you are as an investor and what you think is coming next for the economy. If your main goal is steady income and you're worried about a recession, P&G's safety is obviously very appealing. But if you're hunting for big growth in a booming market, that high price tag and flat volume are probably major red flags, and your money might be better off somewhere else.
Which leaves us with the million-dollar question, or I guess the $326 billion question. Procter & Gamble is, without a doubt, a fortress. It's built to survive storms, but you always pay a premium for a fortress. And the question you have to answer for yourself is whether that safety is worth the price of admission today.